You can see my screen, right? Perfect. So first of all, any one of you guys have any problem regarding the course recording? So the recordings are here in this one. This is the recording of yesterday class. Anyone have any problem to access this recording before we start? Horokol, are you with us now? Let me check basically. I cannot find your name. So probably you'll be watching the recording also tomorrow. I think you get access, right? Let me check here in these messages very quickly. Okay, work fine, perfect. Mark, is Mark with us? Mark, are you here? Unmute if you are here. Okay, I cannot see your name basically. I didn't, Joanna, you didn't basically get access to recordings? You must have basically get an email. Let me check very quickly. God, this is very important, guys. Anyone else than Joanna? You have to use Chrome. Okay. You've got an email to join the We Trade Waves Google group, Joanna, or not? I don't have. Okay, you need to create a Gmail account. Let's check if you have a Gmail account or not, basically on our database very quickly. I'm trying to find basically your name. You have a Gmail basically, Joanna. This Arab, can you see me? It's not on spam also. All right, we'll check. You can check basically in the updates for. If not, we can send you the invitation after this course. I will send you an invitation to join We Trade Waves Google group after this course. Anyone else than Joanna basically have any problem accessing the recording? I will take this note. Anyone, guys? Perfect. So now this is how the things will go, guys. After this class, I will basically prepare the recording, and we will work basically to publish it on our Google server. And then after that, the link will be posted here, all right? And you know, all of you now, like you need to be logged into your Gmail to access this recording. It's simple, just one time, you log in one time. Basically, most of you should be like, for me, basically, I log into my Gmail and it's logged in all the time. So not every time, basically, you need to log into your Gmail in order to access the recording, okay? It's once. So for some of you who don't know, you can use like Gmail in different browser. Like if you have Google Chrome, you can open Gmail in Firefox and you access this in Firefox. I'm sharing the screen basically. Can you see my Slack? Vladislav? Oh, video. Okay, thank you. If anyone shared the video, please stop it. So like I said, you can open Gmail, guys, in different browser like Internet Explorer, Firefox, or Google Chrome, or Safari, whatever browser you have. If you usually use Google Chrome and you use Yahoo as example, you can open your Gmail on basically on Safari, right? And then, or let's say on, not on Safari, you can open basically on Firefox, any other browser different than the default one. Okay, is that clear? Great, fantastic. Now, let me just delete this. This is not needed anymore. We'll delete it later on. Mark, are you here? I think you joined, right? Let's see. Not this part. Get a Gmail account stored. So Mark, you just need to create a Gmail account. It's just very simple. Create a Gmail account, and then it's a lot of crap. I hate it. Upgrade. All right, Mark. We'll basically. Okay, this is basically not respectful. I need to delete this. because every member basically have this access, and we publish this here. We send you an email and we publish this here. I don't know, Mark, if it's with us basically or not. Okay, Mark is not with us. I will ignore this and I will basically speak to Mark tomorrow. Okay, now let's start our class.
Alan, I think he's with the name M. Javed.
Here in this one, let's see.
Yeah. M. Javed is.
Unmute your microphone, please. Sorry, guys, just for the late. I cannot see him basically.
Can you hear me?
I can hear you. Hi.
Oh, sorry. I'm struggling with this laptop. It's not you. It's just me. I'm not very good with laptops and computers. My apologies. It's just driving me mad.
Great. So please delete this.
I'm pulling my hair. I'm pulling my hair out. I don't know what I'm doing here.
Okay, great. What you will do basically, do you have a Gmail account, Mark?
I'm trying to open one, but it keeps kicking me out and asking me.
Okay, great. We can help you even with that. So please delete this comment first of all. It's not good to post this in the general. And we'll help you to create a Gmail account and give you access to the class recording tomorrow.
Okay. How do I do this?
I will delete this comment for you.
Yeah, please.
Thank you.
I was just really frustrated. My apologies.
No worries. Next time, please come back to us and we'll handle this for you.
Yeah, it's just really frustrating, these computers, unfortunately.
No worries. All right, Mark. Thank you.
My apologies. I do apologize. I'm just getting extremely frustrated with this, what to do next, and it keeps asking silly questions.
Okay, this is basically a problem with Gmail, all right? So anyway, we'll not waste too much time in this one.
Yeah.
We'll handle this tomorrow, this one.
Okay.
All right, guys. So basically, first of all, I need to welcome the new members. We have basically a new members who joined us today. Welcome new members. Please go through this Slack to know exactly what you should do. I sent you instructions by email, what you should do. Go to this one, read this one here, guys, and you will get access to this class recording part 1, which is here, to know exactly what we covered yesterday and what we'll cover today. All right? Fantastic. Now, today class, guys, we'll start explaining basically about our methodology. So yesterday it was just introduction, and today class, it will be basically about not only trends or trend line, because trend line are just one single part. What you need to know basically, guys, is the charts is the most important factor here in this wave analysis. Anything we implement to the chart later on, it will be a tool, all right? So once you will start watching the recording tomorrow and after tomorrow, you need just to start writing notes, okay? So anything we do after here, those tools, we use them as tools only, okay? So first thing, chart. First thing, structure. And then after that, we will use those as tools, okay? So tools, this means, guys, it will come after you understand the chart, okay? Is that clear? So trend line, MACD, Fibs, Fib levels, RSI, all of these guys are tools for you to understand and make basically your analysis more clearer towards like knowing where the market is having to go next, okay? So all these are tools. Today, what we're gonna do is not only trends. We will explain the difference between wave analysis, what is wave analysis for us, with like 6 points to 7 points different from us than Elliott wave and Dow theory, all right? So we'll explain Elliott wave, right? Explanation, very brief, general one. And then after that, we will go and explain about Dow theory. We will start with this one because this basically, it came before this. And then what we discover and what we have for our wave analysis, right? So what is wave analysis and what's the difference between wave analysis and Elliott wave? And why, guys, you are mentioning it's wave analysis and not Elliott wave, okay? So basically, this is what we're gonna do today with explanation about trends, why and how we use trend lines, all right? Because, you know, like some of you might use it in different way than us, and some of you might be using it exact way that we use it, all right? But we use it for a specific reason. Remember this and write this as note later on. We do not basically trade trend line breakouts. We use trend line for a different reason and for a specific reason regarding wave analysis, okay? Is that clear? Perfect. So now we will go here through the charts, and we need guys to start explaining about wave analysis. Like we said yesterday, the market will be going like that. Up, correction, up. And then down, correction, down. By the way, all of you guys, you go through the charts today and you start see this pattern. You did that? You did this exercise? You went through the chart yesterday and today and you start like seeing the pattern, like how the market is moving? Great, perfect. So, like I said yesterday, guys, everything happening in the world regarding the Forex market is plotted in the charts, right? Anything happening is plotted in the charts, regardless of who is the participants. Because you know, like you have big banks, you have investment banks, you have brokers, and you have also retail traders, right? Those are small part of this business. You have also not only the big banks, you have also the banks of the countries, right? Central banks. So all of these are participants in this market, right? So anything happening in the world, any transaction, and all the mass psychology of all the market participants is plotted on the charts. And this is very important. Why? Because this is the real data. Here are the real data. The news can be fake, right? This is the real data. What we do here, we analyze the market to understand what they are doing next and what they are planning to do next, all right? So what happened in the world and any transaction regarding in this Forex market is plotted here, and this is what creates waves, right? So the market is not moving because our wave analysis, we understand and we study where the market is likely gonna move next based on our wave analysis. So once you know wave analysis, you will have higher probability chance to know where the market is going next. So this, guys, once you start to hear me saying those words, you need to take note because this is very important. It's higher probability chance. And you know that I'm saying this in YouTube, and I'm repeating this here, guys, for you because we need to go deep in this one for you to understand it and to know exactly how the market is moving, and later on to understand, all right, we are getting this down move because they are preparing the market for this down move, all right? So anything happening here is the real data. We need to agree on that before we continue next. This is the real data. So no one can say that pound dollar, it was not here before, right? So what happened basically, all those analysts before, Dow and Elliott, you know, like Ralph Elliott, you read the book, by the way, right? Guys, you need to read the book and focus only on the pattern's name. So all these analysts, they studied this chart, and what Elliott did basically, he studied, guys, 75 years of data of the stock market. 75 years of data he studied. And he did that, guys, in a pen and paper, right? So only in a pen, he drew the charts, he got the data, and he studied the chart. So he did a great job. And then after that, he invented basically this Elliott wave principle. He is not the one basically who wrote this book. You know that. I will not go into these details, but just I'm explaining to you what he did. So basically, he studied the past. So why the past? Because he has the data of the past. No one can know 100% what's gonna happen next, right? So what they did, they went back and they studied the chart and they said, all right, I can see patterns. So he discovered patterns in the chart where the market repeats those moves over and over and over again. And those moves, basically, they are repeated in a very strict way. What I mean by that, he said basically, his methodology is no less, it's like basically nothing than, he studied the mass psychology of the market participants, all right? So it's the mass psychology. So he discovered that participants, they repeat, right? They repeat his actions, like all the participants repeat their actions over and over and over again. And what this means basically, this means, guys, if you see a pattern here in the past, he said, you should see it in the future. And you will see it in the future in the same way, in the same form. It's not the exact like numbers, it's the same form. And this form, he called it as pattern. So what he did, he basically, guys, studied the chart all the way from monthly to the hourly chart. And now I will go with you guys step by step from Dow theory to Elliott wave theory, the difference between them and what we discovered and what we have difference between us, We Trade Waves methodology and their methodologies. All right? So, and this one, this is basically Elliott wave methodology. This pattern is just like very simple and very known pattern. Okay? Now, before Elliott, we have basically Dow theory. So what Dow is saying and what the difference between Dow and Elliott. Let me just do this again. Great. Now, for Dow theory, guys, what he said the price discounts everything. And this means basically, here in this one, the price is discounts everything. No matter what's happening, it will be discounted in the price. So this means like the charts are the real data. All right, this is for Dow basically. And he said the market move in 3 trends. This is Dow, right? Do not forget that. I'm explaining this for you now. Dow, he said, market move in 3 trends: primary, secondary, and minor trend. All right? And then he said, also you will see in this one 3 phases. So there is 3 trends and 3 phases. And what are the phases? The phases are, guys, if we need just to make a combination between this one and this one, the phases are the fractal nature of the market, the fractals. And what are the fractals? This means the market will move basically in fractals. This means waves within waves within waves. And also Dow say basically volume should support the trend. What this means? Focus on this one. Because he said here volume supports the trends. This means if this is going up here and this is going up, this one here, if you have the volume, you will see like volume should be going up here to support the trend. All right? So Dow said market move in 3 ways. This is what we basically, this is a conclusion for Dow theory. Market move in 3 waves. You have basically 3 trends and you have like also phases. The phases are the fractals. All right? What is the fractals? We will go to this one now and we'll explain it in a very clear way. Okay? He said the trend here in this one to be strong, it should be supported by the volume. So if this is going up here, correction up, this means here the volume should be going up also. If the volume is not going up, this means this trend is not strong. All right? Okay, guys? So he said the price discount everything, and he said also trends have 3 phases. And in addition to that, he said like the volume, it should support the trend. And then if you don't have this volume going with this to the upside, this means this trend is not strong. This like trend weakness. All right? So this is like what you can conclude from like this is a conclusion from Dow theory. Okay? So he said also, this is very important. We'll use this also later on, but just take it as note now. He said like the trend is assumed to be in effect until you have a strong signal, the trend is reversing. So what he means by that? He means like you are in an uptrend until you have a confirmation, a signal here that you are not in an uptrend anymore. So you are not trending to the upside anymore if this is an uptrend. Okay? So all of this, we take the conclusion of this one and we combine it with Elliott. And we came to a conclusion also after we mastered Elliott to our wave analysis discovery. Okay? So this is Dow. You know now what is Dow. I will not go into details. You can watch it on YouTube and you can see the details of it. I'm just taking what we need to take from Dow theory. All right? Now, after Dow, he came Mr. Elliott. And what he said? He said if the market will move in 3 phases, this means it will not be trending. All right? So this is the difference between this one and this one. He said basically this will not be trending. I can see here in this market, after I studied 75 years of the stock market, I can see basically the market here moving in this pattern. Up, correction, up, correction, up. then down, correction down. So here in this one, you can see basically Elliott, he found that the market moved in 5, 3, 5, 3, 5. So this one, they call it a motive wave, all right? So now you need to start learning the terminologies, guys, all right? So how we will check if, 1 second. We have a question. We'll take the question later on, Yaner. So in this one, basically, he called this as a motive wave. A motive wave is this, 5 waves. He called it as a motive wave. It needs to be basically 5 waves, right? And then he called this as corrective wave, okay? So for Elliott, he mentioned this. And he said, guys, I have a rule for that. And the rule basically, here in this one, you will label it 1, 2, 3, 4, 5, right? This 1, 2, 3, 4, 5. And this, you will label it as A, B, and C. And also we have more labels in this one. We'll go into details later on in the label class, but I need to mention this for you guys to understand it very clearly starting from now. So he is using 1, 2, 3, 4, 5 numbers, and he is using ABC, right? W, X, Y, X, Z, all right? Those are basically the only numbers and characters that are used here in this one, okay? So in this one, we have Elliott 3 rules. And those rules are, rule number 1, wave 2 should not go under wave 1. So this one, it can go all the way down 1 pip above this one, upside again. He called it wave 2. So wave 2 should not go under wave 1. Rule number 2, he said wave 3 should not be the shortest wave. You need to focus on this one. Wave 3 should not be the shortest wave. This means if this is like wave 1, correction, wave 3 here, then correction. If this is longer than this, wave 5, it can go like that all the way without stop. So this is his rule, right? And then he said in this rule number 3, wave 4, in this wave, in this motive wave, wave 4, which is this one, should not go down to price territory of wave 1. So this one, if this is wave 1 here, wave 4 should not go down into price territory of wave 1. All right, so this is 1, 2, 3, 4 here, and then 5 here. And then after that, you have A, B, and C as a corrective structure. The problem here, after that, there is no data, right? So after that, what next? What is this pattern? How I can see it in the charts, and what next after that? So for him, what he explained, we are not criticizing, guys. Now we are explaining to you step by step all the details in deep for you to understand the difference, all right? We are not criticizing anyone. These guys, they did a great job. We take this job, we analyze it, and we found a lot of mistakes. We will teach you these mistakes to take advantage of the next wave, okay? If that's clear. We're not criticizing anyone. I'm showing you basically what they did as mistake and what we have in difference between them and we trade waves. So again, and this one, like I was explaining, he said 1, 2, 3, 4, 5, A, B, and C. And the difference here basically, guys, what next? So for him, he will be saying here 1, 2, 3, 4, 5, A, B, C. And then after that, it will be 1, 2, 3, 4, 5, A, B, C. After that, 1, 2, 3, 4, 5, A, B, C. After that, again, to complete what? A wave of a bigger degree. So remember this. For them, for those who trade Elliott wave, they must see here 5 waves. And they must see here 5 waves. And they must see here 5 waves. The problem came basically, I can assure you guys, like, it's not, I will explain to you basically. Big banks traders, I will not name the banks basically, they use Elliott wave also to analyze this, all right? There is some banks, big banks, their traders, they use Elliott wave, and we have charts for that basically, we have proof. They use this to analyze the charts. And what they do most of the time, and this is the biggest problem, they try to prove Elliott wave is working, right? So they try to prove the labeling system. which is not the key, and this is not the goal. Your goal is to make money out of the analysis. Too simply, you need to know where the market is going, take position, take a trade, make money. So what they do, they basically try to prove the labeling system, okay? Which is a big mistake. Why? Because here in this one, what we found now, we found basically impulsive structure, it can be 1, 3, or 5 waves. This is the first discovery. Impulsive structure, for them, it should be 5 waves. Please, guys, mute your microphones. For them, it's 5 waves. For us, impulsive structure or impulse, it can be 1, 3, or 5 waves. This is one discovery. You can write it now. You can write it down as a note later on, and it's very, very important. It makes all the difference, basically. Why is that? Because if you give a chart to anyone, to any Elliott waiver, you give them this chart. Like pick 2 Elliott waivers from different countries, right? And give them this chart. One of them, he will label this as 1. Remember this, he will label, because the thought, like all the thought process for them is labeling. I don't know why, but the thought process is labeling, because they think if they label correctly, they will know exactly where the market is going, which is not the case. The key is the structure. And what is the structure? This is what we will teach you guys during the next days and the next week. Okay? So, in this one, if you give this chart to any Elliott waiver, he will label this first one, he will label this as 1, 2, 3, 4, 5. And the second one, he will label it as what? 1 here, 2 here, 3, 4, and 5. You see that? So they will label this differently, and both of them basically they focus on the labeling rather than trading. Okay? So they try to find the 5 waves within the impulse. And this way basically they will start to make mistakes over and over and over again. Why? Because here in this one, if this is subdivided to this up, correction, let me just put it in this way. If this is going like that, up, correction like that, and then up. Let's assume this is wave 1. I will do it here. If this is like this, right? For them, they will label it 1, 2, 3, 4, 5. For us, we see it at 3-wave structure. Too simply, it's impulsive wave, right? So for us, the difference between impulse and correction, impulsive wave are sharp. So impulsive waves, guys, are sharp and fast. Corrective waves are slow and messy. This is the difference in the characteristics of those waves, all right? Now, impulsive structure for us can be 1 wave, can be 3 waves, and can be 5 waves as well. Now, for this impulsive structure to be 5 waves, here in this one, we respect Elliott wave rules. So if we see this up, correction, up, we will label this as 1, 2, 3, 4, 5. We'll go into this details later on. But here in this one, if it's 5 waves, if we see it 5 waves, it's 5 waves, all right? If we see it 3 waves, it's 3 waves. So the main key here is for you to know and see how the waves is moving, okay? So it's not about proving anything, even later on, it's not about proving that our wave analysis is working. It's for you to make money out of the analysis. This is the goal. It's for you to know how to read the structure, predict the next wave, and basically after that, trade the next wave. Do not think that you need to prove anything. You need to prove yourself that you are able to learn and you are able to predict and trade the next move. And you need to put the work for this one, because this needs practice and you need basically to learn it step by step. You will see me repeating stuff, guys. Like class after class, I will repeat some stuff. Why I'm doing that? Because for you to grab it in faster way. If I repeat it, you will basically remember it faster. Okay? Is that clear regarding basically the impulsive wave? So impulsive wave is a fast move in the direction of the trend. All right? Fast, sharp move in the direction of the trend. Now, step by step, we'll go into details about the trends and the combination of Elliott wave, Dow theory, price action, wave analysis. Okay? So impulsive structures, fast, sharp moves in the direction of the trend. Okay? Now, in this one, impulsive waves, for us, they can be 1 wave, 3 waves or 5 waves. Now, what about this one? For us, this is called a corrective structure, okay? And the corrective structure, this is our rule that basically also will change everything. Corrective structure, they can never be 1 wave. So corrective structures, minimum, they are 3 waves. If you see, like, you know, like sometimes you'll see exceptions, like market went down, sharp up down. All right, well, I'm not here to, there's nothing called 100%, all right? So you might see exceptions, market went down very sharply and then downside again. If you go to lower time frames, you will see here 3 wave structures minimum. So corrective structures are 3 waves structure minimum. This means they cannot be 1 wave. They must be 3 or 5 waves, okay? So impulsive structure, 1, 3, 5 waves, right? I'm not labeling, I'm counting them. So corrective structure, this one, it will be subdivided. Remember this, it will be subdivided into 1 wave, 3 waves, or 5 waves, subdivided. This means if this is a mono wave, I will now start to use terminology, guys, for you to get use of it, okay? So mono wave is 1 wave. You get that? Mono wave is 1 wave, okay? So a mono wave, it will be subdivided if it's an impulse for 1, 3, or 5 waves. A mono wave, if it's a corrective structure, it will be subdivided minimum to 3 waves. If it's 1 wave, it's not a corrective structure. It will be 1 part of the corrective structure. What this means, it will be basically here, if this is sharp up, sharp down, you will see here market going correction, down and then up. This is not your corrective structure, right? This is your corrective structure. We will go into these patterns in week 3. I'm just explaining to you to know basically what I'm talking about, all right? So this is your corrective structure, up, correction, and up. This is not your corrective structure here. So if you have up, sharp down, and then this like that. Here in this one, guys, this is your impulse. This is not your corrective structure here. Why? Because it's 1 wave to the downside, okay? So corrective structure are minimum 3 waves. This is a structure. We call it a running flat. The details will be later on. So your corrective structure starts here, ends here, okay? So this is up, correction, up, okay? Can you see that? All of you, can you see that? Fantastic. Now, second point, what Elliott wave never mentioned it, and we discovered basically after we studied 20 years of analysis, guys, Tia and me, we did 20 years of analysis of the charts to came out what we discovered, right? So, and this one, what he never mentioned is the time factor. And this is what I explained for you yesterday. Corrective structures are time factor. And this one, this will take more time than the previous impulse usually. It's a guideline, it's not a rule. What I mean by guideline? I mean later on, guys, once you are studying the chart and you are here at this point and you need to trade the next move, you can put a rule for yourself, right? Once you are trading, because trading is subjective. This is a rule. This basically, this like a real fact, okay? So trading is subjective. Later on, every single one of you will be trading like different pairs because you are from different countries. So if you are in Australia, as example, you'd prefer to trade Aussie dollar. Someone in America, like USA, he preferred to trade dollar CAD. So trading is subjective because every single one of you have different personality and have different basically ability to handle risk, okay? So what you do here, you analyze the charts objectively and you will trade later on subjectively. Why is that? Like I said, every single one of you have different account size, have different goals, have different basically ability to handle risk. This is a different story. We will cover it later on. Now we are covering the methodology, okay? So later on here, while you will be here, you will put a rule as example for yourself. Okay, I know like corrective structure, it needs to take more time. This means if this corrective structure going sharp down, I will not go for this buy. I will wait this time to pass. Let's say this impulsive structure took around, let's say, 7 days as example, right? you will say, I will not touch this market. I will not touch this trade. I will not trade this next wave until this corrective structure spanned here more than 7 days. You know why now we are dealing with this one? All right, guys? Later on, you will put your own rules to trade the next wave. You will have all the system, but just later on, every single one of you, who will trade like his rules. You get that? Great. So, like I said, this is the third point. What's the difference between us and Elliott? First point, we have impulse 1, 3, 5. Second point, like I said, he never basically mentioned the time factor. And then here, he has a rule where basically we do not agree with him. And the rule is this one. If wave 2 is fast, wave 4, it needs to take time. So for us, this is basically 3-wave structure straight away. Because this corrective structure will be bigger than this, and this will be in a bigger degree. What is the degree? We'll come to this one step by step. Okay? So for them, or for him, this here, he said if wave 2 is fast, wave 4, it will take more time, right? For this one, we do not agree. For us, this is wave up, correction up. This is the corrective structure, and this, it will be basically a corrective structure within this impulse. You get that? All of you get that, guys? Fantastic. In addition to that, he never mentioned what is a monowave and how you can see the monowave, right? So he never mentioned that. So how I can know, guys, that this wave is finished? So if this is starting from here, or if this is starting, it's making more up, or how I can identify a monowave. He never mentioned that, and this is what we do with the trend lines. This is our topic, basically. All right? We use trend line to identify monowaves. So it's not trend line breakout to trade the trend line breakout. It's not like that. We use trend line to identify monowaves. Is that clear? And you know, like the labeling system, what we have difference between him and us in this labeling system. And then also, you need to understand, guys, the fractal nature of the market. Before we go to the trend line and the combination, I need to explain to you the fractal nature of the market, because this is one of the most important aspects of this wave analysis. Okay? So what is a degree? Fantastic, clear. What is a degree, and what is the fractal nature of the market? Like I said yesterday, it's top-down analysis. This means if this is a wave in the monthly chart, it will be subdivided into smaller waves in the weekly chart. And then from here to here, it's a one wave in the weekly chart. If you look at the daily chart, you will see here in this one, also it's subdivided into smaller waves, right? And if you go, guys, and search in Google about fractal nature of the market, go and search about the fractals, you will see, guys, fractals are everywhere, right? We'll not explain this here. Go after that, go to Google and type fractal nature of the market. Go to YouTube, basically, type fractal natures, type fractals, and you will see it everywhere, okay? Also, this fractal nature of the market is implemented, and you can see it here, right? What I mean by that, that's what I'm explaining here. This means market is subdivided into waves within waves within waves, okay? This is what he discovered, and this is what we agree with. So this means this wave is subdivided into a smaller wave in a smaller degree, all right? So fractals, this means waves within waves within waves. Degrees, this means here in this one, this is 1, 2, 3, 4, 5. Those are in the same degree. 1, 2, 3, 4, 5 are in the same degree. This wave 1 from here to here is subdivided, let's say here, in 3 waves, right? Because now you know wave 1, it can be 3 waves. If this is 3 waves here, this means no matter what is the labels here, I'm not just explaining labels, but as an example, let's say this is W, X, Y, right? This wave is smaller than this wave. I'm starting from the same point. Focus on this one. This wave, W, is smaller than this wave 1. This means this degree 1 is bigger than the degree of W, okay? Why? Because too simply, wave 1 is bigger than wave W. You get that? And also this 1, 2, 3, 4, 5 here, it will be basically one wave from here to here, right? And you will label this later on 1A or W regardless. We'll discuss this later on. But this degree here, it will be bigger. Bigger, this means this wave starting from here to here is bigger than this wave starting from here to here, right? So this 1, 2, 3, 4, 5, it will be in a smaller degree than this 1A or W, right? And then here in this one, you will also see 1, 2, 3, 4, 5 as the example here in this one. Those 1, 2, 3, 4, 5, it will be in a smaller degree than this one. So this one is in a smaller degree than this one, and it's smaller than this one. Is that clear, guys? If not, I can repeat it. What is the degree? Is it clear? Agree, yes, clear, Peter. Anyone, guys, if you want me to repeat this, I can repeat it. So I will assume it's clear. Robert, one more time. Yes, please. Okay, I will do that. So like I said, do I agree? Like we agreed, guys, that market is like moving waves within waves within waves. This means if you see a wave in the monthly chart, it will be subdivided into smaller waves in the weekly chart. And in the weekly chart, also smaller waves in the daily, and so on. Okay? So in this one, if this is a wave starting from here to here, like that, right? This one, it will be subdivided into smaller waves in a smaller degree. So this here, it's the bigger wave, right? And then internally in this one, you will see this wave here, and this wave, and this wave are smaller than this one, starting from here to here. You can see that? It's subdivided into smaller waves. And also here in this one, you will see this as 1, 2, 3, 4, 5. Here, you will see this one also is subdivided into smaller waves, and so on, so on. What happens in the higher time frame happens in the lower time frames. Oh, got it. What happens in the, yeah, like I said, in this one, you can see patterns and you can see waves regardless of the time frame and regardless of the asset of the pair, right? So as example, let me just give you an example straight away here in the chart. You will understand it much better. So in this one, this is your impulse, this is your correction, and this is your impulse, right? So in this one, look at this. You can see this like wave going to the downside, one wave. If you go now to the weekly chart, is the mono wave is a higher degree wave. Wait, mono wave, Alim, is one wave, full stop, right? So it's not higher degree or lower degree. Mono wave, the definition is one wave. We do not hear you. Is it from my side, guys? Vladisla say he do not hear me. It's from my side. You sounds good. Great. Okay, thank you. I think Vladisla is from your side. So if you go down here and this one to the weekly chart, you can see now this is down, this is a correction, and this is down, right? So this one, you cannot see it in the monthly. In the monthly, it's one wave starting from here to here. Do not forget those points, these points, it will not, they will not be changed, all right? From here to here, they will not be changed, okay? So now if you go to the daily chart, you will see also the waves within this one. So this one, you cannot see it in the monthly. Here in this one, you can see this is down, correction, down, correction, down. Can you see that? And then you've got a corrective structure. And then here in this one, you can see down, sharp up, down, correction, down. Can you see that? Now in this one, starting from here to here, it's going up, correction, up, correction, up. Now if you go in smaller time frames, you will see also waves here in this one. Can you see that? So let's go to the 4 hours. Let's go to the same wave. I think we cannot go back here in this one. Okay, and the 4 hours, guys, is the same. You will see this one at that. Okay, so for us, regarding now the impulse, for us, this is sharp up, correction, and up. For them, it's 1, 2, 3, 4, 5. Can you start to see the difference? So for us, this is a corrective structure. Can you see the three waves here? Down, correction, down. This is sharp up, and this is sharp up. Can you see that? Great. So any chart, guys, you go to any chart, gold, euro, dollar. I'm just picking this one, just gold, euro, dollar. Any chart, you go for it, you will see those waves. Let's go for gold because basically most of you love gold. Basically, let's go for this one. Let's go starting from the monthly. And this one, you will not see those waves here clearly. So this is from here to here. This is an up move. We will go into trends, guys, to identify mono waves, right? Now, just I want from you to see the waves, right? See the waves and the what I'm looking for. I'm looking at these points. This, and this one for now, okay? So because for me, this is what you do next. This is a wave to the upside. This is the correction, and this a wave to the upside, okay? So now I will go to this one, to lower time frames, to show you that here it's subdivided into three waves. And this is an impulse, by the way, okay? Why it's impulse? Because it's sharp up move, okay? And you can see here this one, the market went in. Most of them, they will call this wave 2. For us, we will never go for that, right? I'm giving you guys the difference to know the difference. And later, because you cannot make something different if you do not master what the others are doing. You get the point? So you need to master Elliott wave and know basically what the weakness point of them. And why basically most of people focus on the labeling, where labeling is just one simple, not important part, okay? One simple, not important part. Take this note. Because the important part here is structures and charts. Just like this, no indicators, nothing on it. If you see it, you can understand it. And even later on, guys, trust me, you look at the chart and you will predict the next wave straight away, right? You will do that later on. So in this one, this is a wave to the upside. And then if you go here in details, this is a monthly chart, right? If we go to the weekly chart, you will see here what not labeled that lag 2. Peter, we will not label this lag 2 because I was just explaining here. This is a fast wave, and corrective structures, usually they need to take more time than the impulsive structure. So in this one, Peter, this is sharp up, right? And this is sharp down. This one, it will not be basically the corrective structure for us. It needs to take time, and it needs to be at least 3 waves, right? So do not forget that. Impulsive structures can be 1, 3, or 5 waves. Corrective structures, they are minimum 3 waves. You will see basically later on some exceptions where the market will be going like that, up, like sharp down, sharp up. This exception, usually you don't have to trade it basically. You will miss this trade, let it go without you. It's not your trade, too simply. We will cover all of this in the psychology class, okay? Now, let's come back to our explanation here. And this one, you notice in the monthly chart, starting from here to here, it's 1 wave. Now here, you can see those 3 waves, up, correction, and up. It's 3 waves. This is impulsive wave, it's 3 waves. So for us, this is up, correction, up, full stop, 3 waves. That's it. Impulsive wave is 3 waves, okay? You got that? Now, if you go more in the daily chart here, more down, if you zoom in here, you will start to see here, this is up, correction, up, correction, up. Can you see that? And then this is the corrective structure. And look now, guys, internally in this corrective structure, how it's developing. Look at this. This is also important. Then, correction, then. Can you see that? So up, correction, up. Remember what we said yesterday? For every move up, we need to have another move up. This is fast. This is fast. Usually, this one, it might be slow because it might be ending structure and then downside again. Those will cover it basically in 3rd week. Now take the concept, okay? For every move up, we need to have another move up. Now internally in this one, if you see what happened here, market went down, it gives us 3-wave structure. Can you see this here? Correction, up, and then downside. Can you see that? All of you now, you must start to see waves, guys. And then after that, market went up, gave us a corrective structure, and then up again. Now this one, starting from here, up, correction, up, correction, up, this will be a degree basically. If this is as example A, here in this one, it will be subdivided into 1, 2, 3, 4, 5, smaller degree than this A. You get that? And then if you go in details here in the 4 hours and daily, in the 4 hours and 1 hour, also you will see here smaller waves. You get that? So the market will start in this. This will form basically a mono wave, give us a corrective structure like that, upside, give us a corrective structure, upside, and so on. It will complete a bigger mono wave of a bigger degree, and then a corrective structure, bigger the corrective structure, upside. You will hear me saying most of the time or sometimes on YouTube, we are expecting a bigger corrective structure. Why I'm saying that sometimes? Because here, once we came to a part of the structure where market give us this, and it needs to give us a bigger corrective structure, this means we need a corrective structure here, guys, bigger than this one. Because remember, those here are in the same degree. Let me repeat this. Up, correction, up, correction, up, right? So this correction and this correction are in the same degree. 1, 2, 3, 4, 5. You will see here, guys, wave 1, wave 2, wave 3, wave 4, and wave 5. All of them are in the same degree, right? Because they are in this wave. You with me? Now, after that, after a completion of a structure, here in this one, you will get a bigger corrective structure. Bigger corrective structure, we mean here, bigger than this one. So if it's bigger than this one, this means here, this corrective structure, it will be in a bigger degree, right? In a higher degree. So this is the impulse from here to here. This is the corrective structure, and this is the impulse. You get that now? If this is A as example, this will be B here, and then all the way up to the next impulse. You get that? After the completion of this mono wave of this structure, you will get a bigger corrective structure again if we are trending to the upside. If not, we'll be reversing there. Is that clear, guys, regarding the degrees? 100%. Robert, yes. Clear, yes. Fantastic. This is very crucial, guys. Great. Fantastic. So now, and this one, guys, one more point, the last point, where basically we have difference between us and Elliott. And once you will rewatch this recording, I want you guys to write down these notes. Why we do not give you this as PDF? Because we want you to write down the notes. We want you to write your own plan, because once you write it, you will learn it faster. Okay, it's for your own benefits. We can do it. We can make PDF, send it to you right away, and that's it. We say to you guys, this is the recordings. Just watch the recording, this is PDF, and do your own job. You get that? All of this is for your own benefits. Even the live session, it's much better than the recordings. Okay? Now, and this one, the last point, Elliott wave, he said basically the X and X, they have a similar look. I'm just going a bit into labeling. We are not labeling, I'm just explaining the difference of structures now. So for those who don't know, X and X are corrective structures, all right? Because you must have read the book. X and X are corrective structures, all right? And wave 2, 4 are also corrective structures. So here in this one, they said wave 2 and wave 4, like I explained before, they have a rule called alternation. This means if this is fast, like I said, explained before this one, wave 4, it needs to go like and take basically, and this one like basically taking more time, right? For us, wave X and wave X, they have a similar look, plus wave 1 and wave 2, they have also a similar look. So they must be in the same degree. They must be equal in the look. So it's not like 100% equal. You must look at the chart and you see like this wave and this wave, they look similar in terms of price and time. Okay? Is that clear? So this is, we do not agree on this one. And we have in addition, wave 1 and wave 2, they must be basically equal in the look, right? Like it's called like similar look. they must have similar look. Similar look, it doesn't mean like same pattern. Similar look, they must basically be equal in terms of price and time. This means like from here to here, they must be equal. You get the point. To be in the same degree, they must be equal. This regarding the corrective structure. This means if this one will be bigger, this in a different degree. And then upside again. Is that clear? No, Emmanuel, 2 and 4, corrective structures. We are talking about corrective structure right now. We are just jumping to other topics, but let's now dive in the trends. Just take this as notes. We'll go into details next like 2 days for this one. Okay? Just take this as notes. Great, perfect. Now, our topic for today basically, trend lines. All right, it's after 1 hour. So basically, like I said, Elliott wave here in this one. Where is it? And this one, this is the Elliott wave, right? This is Dow theory. You just now guys know all these details. And now, in addition to that, the other like retail traders, they trade chart patterns and they trade also trends, right? All of you know like you have a common proverb. It's called like the trend is your friend. This is correct. And like I said yesterday, you have 2 types of traders. Those who follow the trend, they trade the breakouts and all this stuff. And those basically who trade reversals, right? Now, once you understand wave analysis, you will be able to know when the chart is like about to turn and when you can trade with the trend, right? So trend is your friend is correct. And then also before the trend, any trend, it starts from a lower low or like from a lower point, initial start, let's call it. And then any trend to the downside, it will start from a higher point, right? So uptrend, it will start from a lower point, and downtrend, it will start from where? From a higher point, right? So in this one, you will see market is moving like that. Up, correction, up. Now we are explaining uptrend, downtrend, and how we combine all of these stuff. And uptrend, you will see this is going up impulsively. This is the start, right? This is going up impulsively. Here it's what? It's a high, right? And then market will make a corrective structure. This will be what? It's higher low, right? And then upside again. Now here we have a rule, right? Remember, impulse is a correction going in the direction of the trend. So your uptrend, it's not confirmed until you break this top. Clear? So until this wave going up to break this top, you are not in a trending mode. You get that? So you will see, you will basically, we will consider this as a trending mode to the upside once this wave will be going up sharp and breaks this top. At this point here, we will say, all right, guys, now we are in uptrend. This means here we've got a higher high. And this one, we've got a higher high after this point, right? So uptrend is a higher, is like a high, higher low, higher high, correction, this is higher low, up, higher high, and so on, right? So for us, this is an uptrend, okay? And for us also, this here is the impulse, this is the correction, this is the impulse. What they do not understand, retail traders, the time factor, the corrective structure, and when basically the market is in a trending mode, here in this one, and when the market is making just a small corrective structure and downside again. You got that? Now, regarding the trend line and how we use it and why we use it. The trend line, we use it to identify mono wave. And this one as example, how we use trend line. We have rules, guys. Trend line is always to the right side of the chart. An uptrend or downtrend, trend line is to the right side of the chart. Okay? Now, rule number 2. You will connect in the uptrend, here in this one, you will connect the bottoms of the impulses. So in trend line, you connect only the impulses. And also have a rule, you connect the last 2 impulses, right? So you connect the bottoms of the last 2 impulses in uptrend. The downtrend, you connect the top of the last two impulses. This is the rule. You need to write it down. So the rule, trend line also, it's always to the right side of the chart. And then we connect in the uptrend the last two impulses. How you connect the last two impulses? And this one as example, this is the last two impulses. You connect this button with this button, like that. This will be your trend line, all right? And then why we with this one? Guys, once you've got this breakout, this means from the start of this degree to the end of this degree, it's a mono wave of its own. So once you break this one here, two cases. We are getting reversal depending on where we are in the bigger picture, or we are getting a corrective structure and then upside again. Okay? You get that? So in this one, up, correction, up. Let's assume we are here and the market is not developing anymore. You will connect this one, right? And then if the market is here to the right side, sorry, to the left side of this chart and making a corrective structure, upside again, the moment this impulse go up to break this top, you have a new higher high. This trend line, you will change it from here to here. Let me change the color. From here to here, right? You connect the last two impulses, right? And then after that, market make up, correction, up again. You are in uptrend, right? This is a new high here. You will connect this one now. At some point, market needs to break this. Why? It needs to make a reversal, total downside, total fall, depending on where we are in the bigger picture, or we will make a corrective structure and upside again. So this here and this one starting from here to here is a mono wave of its own, depending if those waves here are in the same degree. What I mean by that, let me clear everything. Up, 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 right? And this one here, if the market will make down, correction, down, this is the trend line, right? It breaks. This means here, guys, we are making here a bigger corrective structure. And then in this one, if we get more upside, this means now we have this. From here to here. Those are two impulses of a bigger degree. And this one, we were basically analyzing the smaller degree. This one, starting from here to here. This is a mono wave. This is a mono wave. And this is a mono wave. Why is this a mono wave? Because see here, guys. In this part, you are trending to the downside here. So if you are trending to the downside, this is an impulse. This is an impulse. This means here, starting from here to here, we have a downtrend. So this means you will draw this trend line. Why? Because if we break out from here, this means, and this one, starting from here to here, guys, it's a mono wave of its own. You get that? So always, always, you will put the trend line to the right side of the chart. An uptrend to the right side and downtrend to the right side. Uptrend, you connect the last two impulses. You connect the bottoms of these impulses. And downtrend, you do the same. You connect the tops and downtrend, right? There's a lot of drawings here. And this one, you will connect this point with this point, right? Another rule, guys, we do not cut candles. And also we have a rule, if there is a wick here, you will consider this wick, right? So we do not count candles, and wick we consider because the price, it has been here before, okay? So in this downtrend, you will connect this one and this one, okay? Now, focus on this very well. Once the market starts to go to the upside, and if it breaks this trend line, this means starting from here to here, we have a mono wave. And this mono wave is a corrective structure. And then after that, we are going to the upside, right? We have this up, we'll make a correction, and we'll be going to the upside again. So we use trend line to identify mono waves. Can you see that? All of you, can you see that, guys? Mono wave is one wave. Great. I need to see more yeses basically before I continue. It's getting clearer. Great. So another rule. Once the trend line is broken here, guys, everything to the left side of the chart it will be basically a monowave of its own, right? We said that. Now, remember this. Once the trend line is broken, remember this. It depends on where are we in the bigger picture. We will get reversal or we will get a correction and downside again. Okay? Is that clear? Nice. Now, the last point, always remember, we do top-down analysis. So you will go not only for the monthly chart, you will go to the yearly chart of your pair. Where the yearly chart is here. There is a website called fxtop.com where you can go and find the yearly chart of your pair. Let's just go for it here very quickly to show you an example. This fxtop.com. You go here, guys, and this way you will do your practicals later on. Historical rates, any chart as example. Let's go euro dollar, just for instance, or dollar CAD. Any chart. Name the chart, guys, very quickly. We pass the time. All right. Let's go for euros. All right, we can do that. This is euro. OZ. This is OZ. And here you can select basically start date. You can select 1/1/1953. You click go. And if you click here again, you will zoom in. So basically, here in this one, guys, this is yearly chart, right? And look, market went up, give us three-wave structure. Can you see that? And then up again. What happened? It gives us also three-wave structure and then up again. Depending on where is this stop, where is the higher point here? The higher point is here, right? So if this is a higher point, this means in this one, you have up, correction, up, correction, up, and then all of this is your corrective structure and then upside again. Okay? So you need to find here your impulses to connect the last two impulses of the degree. So in this one, starting from here, the market will be going up, make a corrective structure. You will start here. Once this one going up to break this top, you will put this trend line. Okay? Now, this is going up. If this wave is going up, like way up, and this one, like you have a lot of space between this one and this one, this trend line is irrelevant. Why? Because here in this one, the market will not be going like that to break here, to consider, all right, now I will wait a corrective structure and then downside again. You will never get that. So here in this one, the trend line, it should be realistic. This means this wave, it cannot go like too far of the trend line. You get that? If that's the case, here, if you get a corrective structure, let's come back to the rules. If you get a corrective structure here and then upside again, this correction and this correction, they are not in the same degree. This is bigger and you can see it. This means here in this one, this corrective structure is bigger. Here in this, guys, you will see up, correction, up. Can you see now this degrees? Up, correction, up. If this is the case, I'm giving you an example. All right? So if the trend line is going like that, like this, correction up, we consider. But if this one will be going like that here, this trend line is useless. Because if this market will be going down correctively here, this corrective structure, it will be bigger than this one. So this monowave and this monowave here in this one, this monowave and this monowave are not in the same degree. This is bigger. This means up, correction, up. Is that clear? Great. Now, in this one, you have up, correction, up. Here you have a corrective structure and then upside again. What happened here? This is impulse, and this is the last impulse, assuming we do not know what's happening next. So in this one, you connect the last two impulses, which is this one and this one. Why this one? Because you have here a corrective structure. So in this one, this is the bottom, and this is the bottom of the impulse. Remember, this is your impulse starting from here to here, and this is your impulse starting from here to here. And the uptrend, you will connect those two. Look at this. You will connect those two. What happened after that? Market went down, break this trend line, give us a corrective structure, and then went down again. It gave us a corrective structure, and it went back up. You get that? Now, After that, you will see here market also give us a corrective structure and then up again. Now in this scenario, we'll cover this later on. This might be an expanding flat and then upside again. If this will be going to the upside, here in this one, guys, if this is the top here, you will get an expanding flat, correction, and then upside again. At this point, this is your impulse, and this is your impulse of the higher degree. You can see that? Now in lower degree, you will be doing this job here in lower degrees. In lower degree, you will do this up, correction, up, correction, up. This is your like last two impulses. You will connect this trend line. Once this trend line is broken, this means you will get a corrective structure, like I said, and then upside again, or total reversal. And this one, it's not total reversal because this was a low. It gives us a corrective structure and then it moved up. You can see that? Now, once you finish here, you will go to the trading view, monthly chart, and you start again from the monthly chart. If you go to Euro O's, and the monthly chart, and this one, what you can see, this is our highest point, right? And this one, the market went down all the way from here to here. It made a corrective structure and then downside. At this point, your trend line will be this. Because remember, market will start from a highest point to a lowest point, right? And this one. And the uptrend from here to here. Now, this is the high. We are in monthly chart. And market went down, give us a corrective structure, and then downside. This will be your trend line here. Because this is your impulse and this is your impulse. After that, what happened? Market went up, give us a corrective structure, and up again. What is this one? This is a corrective structure and will be moving down again, depending on the structure, right? So you can see what you are trying to analyze. I'm not saying this going down. I'm just giving you like example for you to start see the waves. So if we can see this, market moving fast to downside, and this moving slow, this looks like a corrective structure. What will be the potential next wave? Downside. For what? To complete this methodology. For downside, we need to have this wave. All right? Now, remember, you might be having monthly uptrend, weekly downtrend, 4-hourly uptrend, right? So it depends on the time frame. And this one, what you will do later on in the practicals, and this one, based on what you see here, this is an uptrend. You can see that? This will be your trend line, and this is a corrective structure, by the way. Why? Because it's going messy, it's slow, and it's taking more time than this one. This is fast. In relationship to this one, this is going correctively like that. You got that? Now, if you go to the weekly chart, this trend line, you will not change it. In the weekly chart, you will go here like to the weekly, and you will analyze what's happening here. Before we go here, look at this. If this is your monthly chart, in the weekly chart, you will see this impulse, correction, impulse, correction, impulse. This will be your trend line in the weekly chart if you trade Euro O's, right? And now here in this one, what happened? Look at this. I'll put this trend line for you guys. This will be your monthly trend line, right? And then down in the weekly, you will see, remember this, right? Down, correction, down. In the weekly, you will see this. So you'll see how the market is subdivided into waves, within waves, within waves, right? In the weekly chart, your trend line will be from here to here. And then what happened here? The market went up, breaks this trend line, give us a corrective structure, and what next? Upside again. You can see that? So your job later on is to identify this point, right? Wait this up, wait this confirmation to trade the next up wave, okay? Do not trade right now, guys. It's just for you to understand the methodology because we have a lot to cover later on. So now we are covering the trend line. And this one, this is your weekly. Daily 4-hour here, you will see basically in the 1 hour also more trend lines. Now, in this one, because you need to go for this one here, this is like the most important part, right? And this one, you need to go for the next wave. So you will analyze this bit. And this one, once you are here, what will happen? The market went up, give us a corrective structure, went up, corrective structure, up again. You can see here, you will start with this trend line, and market went up. Give us a correction structure, give us a corrective structure, and then upside again. You will connect those two impulses. Why? Because this is fast, and this fast. Impulse is a sharp wave going with the direction of the trend. Here in this one, you have an uptrend, right? Market went up, give us a correction, break this, uptrend again. You got that? So this here and this one, your trend line will be here. I'm giving you examples, guys, for now. You will do this practicals later on, step by step, next week. What happened here? So up, correction, up, correction, up. Market went down. This means from here to here is a mono wave for now, right? We don't know what's happening next. For now, this is one mono wave, right? Starting from here to here is one wave. This means what's happening next, it will be a corrective structure or reversal. Here in this one, you will be expecting a corrective structure. Why? Because this is sharp down and this sharp up. If this is sharp up, this is not a complete structure. This means I need more waves here before we go down. You can start, guys, to see the concept. So this means here, if this is sharp up, I need a corrective structure, which is what we've got here, and then upside again. Now, at this point, look what happened. This is up, this is correction. You can see that this corrective structure is bigger than this corrective structure, right? So at this point, here in this one, you will understand that this mono wave, then correction, then. You will know that this mono wave, which is a corrective structure, it's bigger than this one. This means here in this one, if this is, let's say, 1, 2, 3, 4, 5, for A as example, right? Then this corrective structure, it will be the same degree as this one. So up, correction, up. Those three waves are in the same degree. Now this wave is subdivided into smaller waves in a smaller degree. This one in purple, right? And then in this one in yellow, this one, like the waves in the same degrees. Can you see what I'm trying to explain to you guys? Those waves are in the same degree. Can you see that? Now, after that, the market went in, give us a corrective structure, and then downside again. Here in this one, you're in a downtrend. Can you see that? You will connect this here, this one, and the market went up. Give us the last impulse here. Now, in this one, you will be in an uptrend, right? You can see that? So in this one, if you go to the daily and 4 hours, in this one, this trend line, once this is going up, correction, and up again, this trend line, you do not need it anymore, right? We do not trade trend lines. So in this one, you have up, correction, and you have up again. This trend line is not needed. You will connect this one because now you have a bigger trend. You get that? Why you need to connect this one? Because this is your impulse now. This is your impulse now. This is your correction, and this is your impulse, right? At this point, like I explained before, at this point, guys, you will be expecting what? The market to make a reversal to the downside or a bigger corrective structure. So the market here went down, up, and we break the trend line here. So in this one, because this is making like a lot of waves, this means it's not going sharp like that, right? So if you can see here, market give us a corrective structure and then went back up. Can you see that? So starting from here to here now, it's a mono wave. Remember how we are following the market step by step. Up, correction, up, correction, up. This is our mono wave here, right? And then this mono wave here in this one, and it's a mono wave in a smaller degree than this one, starting from here to here. Can you see that? And then what after that? Market give us a corrective structure and went back up. Can you start see, guys, the trends? This is up, correction, up. For every move up, we need to get another move up. Anything happening in between, it's called correction. You need to understand the degrees and you need to understand the trends. 14 message. Oh, yeah. Okay. I thought those was questions, to be honest. So 14. Kuvu, you need to go. Okay, this like I will take this question as like you need to do the work, right? You need basically if there's something higher than yearly chart, you need to do it, all right? Just to gain experience at the moment. You are starting to building experience. Great, nice. How to reverse is confirmed after which low is broken. Alim, good question. So a reversal will happen after a completion of structure. Let me just continue with this one very fast, just for you to know, guys. So in this one, we've got this up wave. Market give us a big corrective structure and up again. Now this is your trend line, right? Because you have a new higher high for this degree, up, correction, up. Okay, now this trend line is not needed anymore. This trend line is not needed, it's in the past. This is the trend line that you need for now. If you go to lower time frames, you will see a trend line here, right? Now, after this wave down, what we need? We need a correction and then downside again. If this will happen, guys, this is what's called basically, Alim, this is what's called basically a reversal. If you go in the 4 hours as example, up, down. Let me just explain to you here very quickly because we passed basically a lot the time. It's 1 hour and 30 minutes. The recording will be too long. So the reversal will be at the end of structure. You will get fast up, fast down, correction. This is the reversal. After a completion of a structure in a bigger degree. So if this is going from the upside, you get a corrective structure here. This will be the reversal. Okay? So the reversal, it's sharp up, sharp down, correction to the downside. If this is like a completed structure in the bigger degree. In the uptrend, you have sharp down, sharp up, correction, and then upside again. You get that? So reversal, it's two sharp moves in the opposite direction. But you need to have a complete structure. We need to stop the recording, guys. It's almost 1 hour and a half. We explained a lot of stuff in this class. We will take questions tomorrow. Prepare the questions, guys. We will take it tomorrow because we cannot explaining for now. See all of you tomorrow, right? Any quick question before we end it for today? Watch the recordings. It was equal so much to take. Yes, it was basically.